The broadcast is now starting. All attendees are in listen-only mode.
Good morning and thank you for dialing in to the Rural Funds Group financial results presentation for the year ended 30 June 2021. We will commence the webinar shortly at 11 a.m. Thank you for dialing in and we'll be back with you in a moment. Good morning, ladies and gentlemen, and thank you for standing by. Further to the disclosures lodged on the Australian Securities Exchange this morning, welcome to the Rural Funds Group financial results presentation for the full year ended 30 June 2021. My name is James Powell, and also presenting today is David Bryant, Managing Director, Tim Sheridan, Chief Operating Officer, and Daniel Yap, Chief Financial Officer. For your information, all participants are in listen-only mode. After the presentation, there will be a question and answer session. Please feel free to type your questions in the questions fields during the webinar, and we will address these at the end of the presentation. Please also be advised that the webinar, including Q&A, will be recorded. I will now hand over to the first speaker, Tim Sheridan.
Thanks, James, and good morning, everybody, and thanks for your attendance. I'll commence today's presentation with an overview of the FY21 financial results. The first page of the presentation, do you mind changing slides, James? Sorry, thank you. The first page of this section details the income, earnings and balance sheet metrics for the group at the end of 30 June. Firstly, income and earnings metrics as presented in the top right-hand side of this page, consistent with prior forecasts, RFF recorded lower property income in FY21 compared to FY20. This is primarily as a result of selling the poultry assets and the Morel almond orchard in prior years. Capital from the sale of these assets has been redeployed into macadamia development assets, which are expected to add materially to property income in future years. This will be discussed later in the presentation by David. Offsetting the reduction in income was revenue earned on the acquisitions, development capital expenditure, the increase in the J&F guarantee from 82.5 million to 100 million, and lease indexation mechanisms. Despite lower property revenue, total comprehensive income and earnings were approximately double of what was generated during the prior year, or 36.5 cents per unit. The higher earnings was driven primarily by independent valuations, which were arranged for 3/4 of the assets in FY21. Adjusted funds from operations, the net cash generated by RFF was 11.9 cents per unit, slightly ahead of the prior forecast of 11.7 cents per unit. Distributions of 11.28 cents per unit were paid during the year, which was in line with prior forecasts. Next, I'll look at the balance sheet metrics as presented in the table on the bottom left-hand side of this page. Included in this table are pro forma figures following the entitlement offer completed shortly after 30 June this year. I'll refer to the pro forma figures being the more current metrics for investors. Adjusted total assets of the Rural Funds Group are now $1.2 billion. As a result of these adjustments, we recognise the water entitlements at their independent valuations. External borrowings are $290 million and gearing is 25%. This is well below the target gearing range of 30 to 35%, and therefore the group has balance sheet capacity which can be deployed on acquisitions and development capital expenditure. Again, David will talk further to these strategies later in the presentation. Finally, on this slide, the net adjusted value has increased by 13% to $2.20 per unit. Similar to total comprehensive income and earnings, the net asset value has increased following the independent valuations, details of which are presented on the next slide. The graph on the right-hand side of this page details movements to adjusted property assets grouped by agriculture sector. The group started FY21 with $997 million of adjusted property assets. In December, the Morel almond orchard was sold, as shown by the green bar on the graph, and valuations were received for the remainder of the almond orchards during the period with a combined increase of $5 million. Cropping assets increased $65 million during the year from the acquisition of 21 sugarcane farms. These farms are currently being operated as sugarcane farms prior to their future conversion to macadamia orchards, and therefore are classified as cropping assets. The cattle sector recorded a $63 million movement, including uplifts in valuations for the Natal aggregation, Kabungra, Mutton Hole and Oakland Park. Combined, these revaluations totaled $46 million and were driven by a combination of productivity developments and buoyant market conditions. Drivers of higher property prices are high cattle beef prices, low interest rates and good seasonal conditions. Several properties have been acquired and are currently being developed to macadamia orchards, which were recorded in the $48 million movement attributed to this sector. Other movements include increased valuations for RFF's vineyards and unleased water entitlements. As a result of these movements, total adjusted property assets ended the period at over $1.1 billion, as shown on the bar on the far right of the chart. Introducing the capital management section of this presentation is a very recent picture of cattle grazing on improved pasture. Do you mind just going back to the photo? Apologies. Cattle grazing on improved pasture, a property in central Queensland called Rewan. This property was also revalued during the year. Next slide, please. Considering now the capital management of RFF, the most significant event was the issue of $100 million of new equity, which was raised by an entitlement offer in July and August this year. The offer was conducted at a price of $2.47 per unit and was taken up by approximately half of existing investors. The remaining equity was raised from institutional investors who sub-underwrote the offer. The chart at the bottom of the page shows the total return for RFF investors from July 2014 to present compared to the ASX 300 A-REIT index, a very pleasing result. In terms of the debt facility, the overall limit was increased to $380 million in FY21, and RFM is currently arranging the refinance of a portion of this facility prior to its renewal date. RFF's financiers continue to indicate their support for the ongoing growth of the fund and the facility. During the period, $60 million of new forward-dated interest rate hedges were entered into as RFM seeks to take advantage of low debt funding costs. The table on the next page considers the debt facility and the interest rate hedges in greater detail. Like previous pages, I'll refer to the pro forma metrics which adjust for the recent equity raising. The cost of debt was 3.2% in FY21 compared to 3.7% in FY20. Please note this calculation includes the cost of interest rate hedges. 64% of debt is hedged and the facility has $94 million of headroom based on the current limit. I'll now hand over to David Bryant to provide a portfolio update, including areas of growth for RFF. Thank you.
Good morning, ladies and gentlemen. Before I move into the next section, the picture here is raw cotton, which is in bales ready to go to the cotton gin. That photo was taken on Mainland, one of RFF's properties. Mainland's been undergoing development initiatives to improve its productivity. These developments include expansion of irrigated cropping areas and water storages. Actually, the picture on the front of the presentation is a picture of a full water storage on a property nearby, Lenora Downs, which is another cropping property owned by the fund. The development of these assets is an integral component of RFM's strategy of maximising the value of RFF assets for RFF unit holders. So I'll now provide an update on the progress of this strategy with respect to macadamias. So as described in the first half of this presentation, RFF currently has balance sheet capacity which is being directed towards macadamia orchard developments and the purchase of cattle and cropping properties. As you can see on the map on this page, RFF has acquired land and water sufficient for the development of 5,000 hectares of macadamia orchards over time. We now have over 100 hectares planted. There's 500 hectares will be planted in the next 2 months, and by this time next year, 1,000 hectares will be planted. We are confident that by having the orchards planted before contracting lessees, we can achieve a higher rate of return for our unit holders, and this is for several reasons. First of all, a picture is worth 1,000 words, or seeing is believing, particularly for institutional investors that are unfamiliar with agriculture or investing in it for the first time. Secondly, by having the orchard planted, we're another year along the development timeline, so the mathematics for the investment analysis is actually better. And then thirdly, and significantly, by having the orchard planted, we've removed risk. So over the next year, RFM will complete the initial development of 1,000 hectares and seek a long-term lessee on terms that are attractive to the unit holders of RFF. After allowing for this development expenditure, RFF has $100 million of capital that can be allocated to cattle and cropping acquisitions. RFM has already agreed terms with potential lessees for cattle acquisitions, and we are currently in an exclusive due diligence period for a sizable cattle property, a property that has potential for a substantial increase in carrying capacity. We've also identified opportunities in the cropping sector, similar to Mainland and Lenora Downs, that are assets in growing regions with development potential. The next slide shows the financial return RFM has achieved on assets with these attributes. That is the ability to convert to higher and better use or improve productivity. The case study on the right of this page highlights the productivity improvement strategy. We've used the property Comanche, which is 7,600 hectare cattle property that we acquired in July 2018. Since acquiring that property, we've installed centre pivot irrigators, further watering points and improved pastures. Those developments have cost $3.3 million and has helped to increase the carrying capacity of that property by about 50%. By adding that carrying capacity, you're adding to the productivity of the farm. You're increasing the profits that the lessee can make from their cattle operations, and because the farm is more profitable, it is more valuable. Through a combination of buying properties at a reasonable price and buying properties with unutilised natural resources, and then improving them, we believe we can generate 15% internal rates of return on specific assets over a 10-year period. The strategy is similar for cropping properties. Relatively small quantities of CapEx to fund relatively large increases in productivity. We've listed RFF cattle and cropping properties at the bottom of this table on the right of this page, which are undergoing this type of development. The case study on the left of this page is in relation to higher and better use development strategy and describes the Morale property at Hillston that we acquired as lower value cropping country and developed it to almonds and then sold it recently for $98 million. Again, this strategy generated a greater than 15% internal rate of return. This example is a direct parallel with what we are doing with macadamia developments, buying cattle and cropping properties and then redeveloping them to a higher value crop. RFF has acquired $104 million of land and water suitable for macadamia plantings. At Maryborough, we have 5,000 hectares of arable land. Half of it will go into macadamias, which will then fully commit the water entitlements we have there. The other areas will be utilised for other types of cropping. At Rockhampton, we have thousands of hectares of land and we have acquired sufficient water to plant 2,500 hectares to macadamias, as well as to support irrigated cattle. These acquisitions have been funded by the sale of the poultry assets in FY20 and the Morale almond orchard in FY21. While the sale of these assets has led to a reduction in the AFFO in these years, RFM expects the AFFO to reset higher than previous levels as these assets are developed and leased. Furthermore, additional AFFO accretion is expected to be driven by new cattle and cropping assets acquired from balance sheet capacity. Despite the portfolio still undergoing this transition, RFM is pleased to confirm the FY22 forecast distributions of 11.73 cents per unit, representing 4% growth on FY21. Moving now to the conclusion of this presentation, fittingly, a picture of a mature asset of RFF, the Gaia vineyard in the Barossa Valley. This vineyard was developed by RFM starting in 1999 and has for well over a decade been producing high-quality grapes, supplying Treasury Wine Estates premium labels. I'll now hand over to James to conclude today's presentation and then we can commence Q&A. Thank you.
Thank you, David. As noted, we'll shortly commence the Q&A. Just a reminder to participants, if you have a question which you would like answered from David or Tim Sheridan, Daniel Yap, or myself, please type the question into the questions field and we will receive it and answer it. However, now just moving to the conclusion slide. In summary, the presentation today has shown that the Rural Funds Group is poised for additional growth and specifically RFM will be continuing the proven strategies of converting assets to higher and better use and seeking acquisitions with productivity development potential, both of these strategies seeking to increase AFFO. We've presented some investment, financial and portfolio highlights on the right-hand side of this page for you to review at your convenience, and note that in the appendices there is more information on the financials as well as the portfolio itself. This concludes the formal component of today's presentation. We'll now just pause for a moment to give attendees the opportunity to type questions into the questions field, and we will be back with you shortly.
Hello again, it's David Bryant speaking. We've got a question here regarding asset valuations. It's a question regarding the names of the valuation companies and how many years they've been valuing them. I'll actually hand over to Tim Sheridan, who, rather than provide you an extensive list of the valuers, I'll probably just address that first of all, and that is that we use national valuation firms, and we have a policy where we cycle through valuers after a period of years, and Tim will answer how many years that is. Before I hand over to him, another part of this question is, will future dividends continue to be paid out of annual income? Yes, that is the case, although you might see in the presentation we're forecasting that our payout ratio will go to 101% this year. We see that as a transitory thing as we increase funds from operations as we enter into new leases, both for macadamias and these expected cattle and cropping acquisitions. And so we don't expect a further increase in payout ratio beyond that. And now, Tim, I'll just ask you to address the valuation policy.
Yeah, so thanks, David. The policy is to rotate valuers every 3 years. And on slide 22 of the presentation, you can see a list of those valuers and which valuers are actually valuing which property. But we have a policy to rotate them every 3 years.
Okay. And so David Bryant speaking again. Some further questions. Please advise strategies to address climate change challenges. So that's an issue that we continue to work on. We've done benchmarking of our cattle operations to establish the actual greenhouse emissions that are occurring from that enterprise, and we'll probably extend that to other enterprises on a systematic basis. And we're investigating the carbon offsets that can be generated from many of the natural resource assets that the fund has. So it's a work in progress, but we have staff that are dedicated to this particular issue regarding greenhouse emissions from the fund. And in fact, we're meeting part of a regular meeting on that tomorrow. In terms of addressing climate change challenges for the fund's lessees in particular, we manage this specifically by climatic diversification, and that's why if you look at the distribution of the assets of the fund, we are spread across numerous climate zones on the Australian continent, and we feel that that's the best way of defending the fund against extremes in climate. Another question, which is how would the fund's profitability be affected by a rise in interest rates to, say, 5.5% from currently historically unprecedented low levels? I don't have that calculation at my fingertips, although we have modelers who can actually give you that answer within a minute. But it's first to say an increase in interest rates would increase our cost of debt. We have about 60% of it hedged at present, so the impact on our debt funding costs would be largely mitigated by that hedging. And in the case of our lessees, we would not expect that would be detrimental to their business, primarily because the driver of an increase in interest rates is probably an increase in inflation, and food prices make up a significant portion of that. And as we're seeing at the moment, we're experiencing a period of very, very good commodity prices. So we think the fund has existed through periods of higher interest rates that have been nominated, and we think the fund would be largely unaffected. Of course, it would be interesting to see what happens to the trading price of the fund in the short term as the market readjusts to the requirement or expectation of the higher bond yields. Okay, am I able to provide colour around water availability for the macadamia orchard development? We've secured the water at Maryborough. That's coming from the Mary River, and the water entitlements for the other half of the developments is coming from the Fitzroy River. There is a weir being built on the Fitzroy River, on which one of our farms fronts onto where the weir is being built, and that weir will store sufficient water, and we have sufficient entitlements to that water so that we can plant 2,500 hectares of macadamias in that area. So the Fitzroy River and the Mary River are the source of the water entitlements. Do forecast future earnings depend on a continuation of increasing asset valuations? No, they do not. The increasing asset valuations do, however, contribute to increased lease rentals over time, and so the ability to continue to increase our distributions rather than the current rate of distributions is correlated with increasing asset valuations. So just some comments on that. Over the past 120 years, agricultural land values have increased 4.5% per annum compounding. The industry, the sector, has a very long history of seeing asset values increase. You go through periods of faster growth, as we are experiencing at present, and then periods of slower growth. There are occasional periods, very rare, of declines in asset values. I don't see the potential for that at the moment, because if I look at the economics of our lessees, economics of the enterprises that they're operating, the current valuations are very sustainable. So question, which is, with interest rates so low, is the target gearing range still appropriate? Should it be higher? Well, that would be tempting unless interest rates went up. So probably the answer is no. I think that the gearing range is appropriate given the levels to which banks will fund agricultural properties, and that's typically they will handle gearing of 50%. Prior to the GFC, they used to run at higher rates. We think it's prudent to run a buffer between maximum gearing that banks will lend to and our target gearing range. So I think we'll stick to where we are, and the fund is doing quite well financially, and the portfolio is doing very well. I think it's that the gearing is sufficient. Question about the mouse plague and whether it's affecting our assets or plantations, and no, we've been largely unaffected by the mouse plague, and it's passed. Although one will come again, we can be certain of that. It's manageable. We did have some mice damage on the cotton crop at Lenora Downs early in the season, but that was controlled, and then the crop grew on and recovered from it. Question regarding, Tim, I might give you this question, which is a question, can you talk about the cattle lessees, what is driving the increased demand? So that I think that question has just gone to you, Tim. I'll give you a chance to read that. We're all working remotely, so please bear with us, ladies and gentlemen, while we spin the questions across the ether. In the meantime, I might answer another question, which is, do you see increased adoption of carbon pricing globally as supportive for rural property valuations? I don't know is the answer. I will have to ponder that, and we'll come back to the questioner directly, but perhaps maybe put something in a newsletter regarding it as well. It's a very interesting question.
David, I can jump in with the cattle lessee question. I think the question's referring to what is increasing the demand of people wishing to lease properties. I think our name's just getting out there more, and we've got a track record of acquiring good properties, and people are wanting to lease properties off us. We've got a larger book of lessees, and those lessees that we currently lease properties to, they're wishing to expand. And I guess the way that with property prices increasing, people don't have the capital to buy both the land and the cattle. They can only buy one thing with the property prices increasing so much, so they are seeking to lease more properties. I think that answers the question, but if not, Grant, you can come back to me and I can hopefully clarify.
Okay, and then one last question, which is, can we explain how the guarantee works? I assume that question is referring to the guarantee that we provide to JBS Australia in relation to a cattle financing facility. So the fund finances cattle contained in the fund's feedlots. The feedlots are leased by JBS and managed by JBS. So they grow the cattle out. The fund owns the cattle, and we provide a guarantee. It's similar to providing equity in a financing arrangement, and we receive an equity rate of return for that guarantee. The guarantee is currently limited at $100 million. And that equity rate of return that the fund has been achieving has been an excellent investment for RFF, generating high rates of AFFO from an excellent counterpart. All right, I think one last question. Do we have a view about buying land in Tasmania? My main view is I wish I had bought land there 5 years ago. It's gone up a lot as elsewhere, but we've actively looked at land in Tasmania to acquire, particularly interested in grass-based grazing systems for cattle in particular, but also other livestock. We were unable to line up lessees at the time that we had the particular assets in sight, and those opportunities have now passed, but not permanently. I think they'll come again, and we think that Tasmania is an excellent investment destination. It's an excellent place to be farming. And all right, well, look, I think we've addressed all of the questions. Ladies and gentlemen, thanks very much for your interest and your participation in this morning's webinar, and we look forward to speaking again. Thank you very much.